Hello traders, welcome back to the Forex Jig. In today's video, we are going to be talking about the best indicators for options trading. These tools can help you make smarter decisions and spot opportunities in the market. We'll break down the top 4 indicators that every options trader should know, showing you how to use them effectively. By the end of this video, you will have a solid grasp of these essential tools and be ready to apply them to your own trading. So get ready to level up your options game. Let's get started. So the first on the list is a very popular indicator in options trading, and it's none other than the moving averages. So this video will be focusing on the simple moving average, or SMA. So let's put it on our charts. Just gonna search for SMA moving average simple, and it's gonna come on the charts. Just edit it. I'd like to use the 21 day moving average. Okay, so it's gonna, so this is the moving average. So the moving average works by smoothing out prices that are making it easier to spot the overall direction of a trend. It's calculated by taking the average price of an asset or a currency price over a specific number of periods, like 20 days or 50 days. In this case, I'm using the 21 day period moving average. You can see I put it in my settings. You can come here, hit the setting and edit it. You can put the 50 day. You can use the 50 day and it's going to reflect. Well, this is the 50 day. So I guess I'll use the 50 day for the example. So let me show you how to use the moving average when trading options trading. So if the price is consistently above the SMA, it suggests an uptrend. If it's below, we are likely looking at a downtrend. So when the price crosses above the moving average, it can signal a potential trend change. Above or below it, if it crosses above or below, it suggests a potential trend change. So you can see this. We have price cross below this right here. Price was initially bullish and had this cross to the downside, signifying a potential trend change. You can see price after the breakouts. You can see this retest. Price retested the moving average right here, confirming the bearish trend. You can use this to enter better trading opportunities. You can see this downtrend from that confirmation, and here price broke out. You can see here price broke out and retested the moving average line, continuing the uptrend and remaining above the moving average. You can see this right here, which means that we are in an uptrend. You can see another example here. Price went below the moving average right here and retested it here, giving us a confirmation. I see this engulfing candle right here, giving us a confirmation to continue this bearish trend, but it didn't last. Had crossed to the upside. See this upside movement here. Price retested the moving average and continued to the upside. So that's how you can use the moving average to trend. It tells us the direction of the trend, whether we are in an uptrend or we are in a downtrend. It helps identify trend in an options market. So that's how you can use the moving average. The key to using moving averages is to use them as a guide, not a rigid rule. They work best when combined with other indicators and analysis and techniques. However, as a foundation for your options trading strategy, the moving average is a powerful indicator to have in your arsenal. So Let's move on to the next. The next on my list is the RSI indicator. I know you must have heard about the RSI. We've talked about the RSI in our previous video. If you don't know what the RSI indicator is, we talked about it in depthly. You can check it out. It's on our channel. So let me just brush through what the RSI means. So RSI is a powerful momentum oscillator, and it helps in spotting overbought and oversold conditions in the market. So let me put that on the chart. Just going to search for RSI, which is the relative strength index, RSI for short. So it helps us spot overbought and oversold conditions in the market. So let me find a good example. You can see price being overbought right here. The RSI signified that it was over. When the RSI goes above 70, it suggests that the currency, the asset, might be overbought and due for a pullback. So when it dips below 30, it could be oversold and hinting at a possible upward bounce. These levels can signify potential reversals, giving you a heads up on when to enter or exit a trade. So you can see this example I was showing here right here. You can see this price, the RSI was overbought, and price gave us this rounding top pattern. Yes, you can see this was a round top pattern signifying a bearish trend. So you can see this pullback from that overbought zone to the downside. You had this oversold, level right here, but price was making constant bullish. I'm going to explain this. This is divergence. I will explain it right now. But let's just focus on spotting overbought and oversold conditions. You see this overbought level right here. RSI was overbought slightly for a minute, and you can see the massive pullback to the downside right here following the RSI. See further examples like this one here. See the RSI being overbought and price respected that. See price with the bearish movement from there. See this bearish trend right here. So that's how you can use the RSI to spot overbought and oversold levels. You can see this one right here. See the RSI was oversold right there, and price was sold here. You can see this massive bullish movement to the upside. See that? See this price was overbought. RSI here. You can see this signifying potential bearish reversal. You can see that right there. So we had this, and we had the overbought signal from the RSI and signifying a bearish reversal coming. That's how you can use the overbought and oversold conditions, but don't just blindly follow these levels. Use them as a starting point. In strong trends, the RSI can stay overbought, oversold for extended periods. So let's talk about divergence. Another way you can use the RSI is by spotting divergence, bullish and bearish divergence. So divergence occurs when price is moving in contrary to the RSI. For example, if price is giving us a bearish trend, higher highs, higher lows, and lower highs, you see the RSI giving us a bullish trend with higher highs and higher lows. That means that there is a divergence, and we may be looking for a potential reversal to the upward side or to the downward side. Depends on the divergence at play. So there is bullish and bearish divergence. You can see here this price was giving us these bearish movements right here. We are seeing higher lows, lower highs, price was making lower lows, lower highs, lower lows. But the RSI was doing something different. This is an oscillator, so it was oscillating to the upside. You can see making higher highs, higher lows, higher highs, higher lows. This signifies a divergence and price might be due for a reversal, and that's what happened right here. You can see price giving us this is a bullish divergence, so price gave us this very strong upward move after that. So that's how you can use the divergence to trade. That's one way to use the RSI. You can also combine the RSI with moving averages to confirm your trades. So RSI is a fantastic tool, but it works best as part of a broader strategy. Use it wisely and it could become an invaluable part of your options trading toolkit. So the next on the list is the Bollinger Bands. So I'm going to delete all of this and insert the Bollinger Bands. Bollinger Bands. This is it right here. So the Bollinger Bands is a powerful tool for measuring volatility in the options market, developed by John Bollinger. And these bands consist of three lines: a middle band, typically a 20-day simple moving average, and two outer bands that expand and contract based on market volatility. So you can see the trade lines. There's a middle band and two outer bands. This middle line is a 20-day simple moving average. So it means that when price is above the middle band, we are bullish, and if it's below it, we are bearish. Just how to read this moving average. We discussed it earlier on in the video. So you can see the beauty of the Bollinger Band lies in their ability to adapt to market conditions. When the bands squeeze together, it usually means volatility is low, and this compression often leads to a significant price move. You can see this squeeze here. After the squeeze, you can expect price to break out to either direction. You can see here, after the squeeze, you had this massive bullish move. There was a squeeze right here. You see the squeeze right here, and you see this massive bullish move to the upside. See, there was another squeeze right here. You can see price reacting off of that. This was a squeeze. See price reacting off of that, giving us a bullish movement to the upside. See another squeeze right here. Wasn't too tight, but yeah, you understand. So this is another squeeze, and after that squeeze, you can see price giving us this massive bearish movement. So that's how to use the Bollinger Band squeeze. Now, but you should watch how price behaves when it hits these bands. If price bounces off the lower band and crosses above the middle band, that's often a good signal to consider buying call options. Similarly, if price rebounds from the upper band and crosses below the middle band, you might want to look at put options. So you can see price here, say this example, price was coming from the lower band and crossed the middle band, which is the moving average. So we should be considering call options, buying call options, you understand? Crossed above the middle band, gave a retest to this, we should be considering call options. Take profit should be at this resistance here, this nearest resistance level there. Just to look at that lower time frames, and this will be a very massive move to the upside. So you can see this one, price went below the middle band, from coming from the upper band, went below the middle band, and you can see this bearish trend continued from here to the downside. So you could consider putting in put options. when price breaks below the middle band and continues to the downside. So that's how you use the Bollinger Bands to trade. The next is the Moving Average Convergence Divergence, which is popularly known as the MACD. So I'll delete the Bollinger Bands right now. Delete the Bollinger Bands. The next is the MACD. And let me put it on our charts. You can see the MACD, Moving Average Convergence Divergence. So the Moving Average Convergence Divergence is a versatile indicator used by options traders to identify momentum and potential trend reversals. So the MACD consists of three components: the MACD line, the signal line, and the histogram. The MACD line is the difference between two moving averages, typically the 12-day and 26-day EMAs. The signal line is a 9-day EMA of the MACD line. The histogram represents the difference between the MACD line and the signal line, and you can see it's either red or green. The histogram shows the red color or the green color, which is the difference between the MACD line and the signal line. So interpreting MACD signals is straightforward. When the MACD line crosses below the signal line, it generates a bullish signal. The MACD line in this case is the orange line, the MACD line. The signal line is the blue line. So it's going to signal a bullish momentum entering the market, bullish movement, when the MACD line crosses above the signal line. Conversely, when it crosses below, it's a bearish signal. So these crossovers can help you time your entry and exit points in options trading. So for example, you can see this bearish move right here was confirmed using the MACD. You see the MACD line. You see this MACD line crosses below the signal line, which gave us confirmation for this bearish signal right here. You can see the histogram also giving us a red color and it's below 0, confirming the bearish movement. See that? For the bullish movement, you can see this one right here. The MACD line gave us this cross, and there was this cross here also. You can see this bullish movement started right there. See the histogram confirming it too with the green bars, and you can see price giving us a nice bullish upward movement from there. So that's how you can use the MACD to trade. So combining MACD with other indicators like RSI or Bollinger Bands can enhance accuracy, can help filter out false signals and provide clearer picture of market conditions. So that's how you can use the MACD to trade. You can see this massive bearish movement right here. See the MACD line going below signal line, and you can see here price confirmed it, and you see the massive bearish move to the downside. You see that, and you can see this histogram bars giving us a red color as it's below 0. So that's going to help us confirm that the MACD is going to the downside, and also price should follow suit and go to the downside. So that's how you use the MACD in trading. So these tools, the 4 of them, are only as good as how you use them. So take time to practice with each indicator, understand their strengths and limitations, and most importantly, find the combination that works best for your trading style. The key is to start simple, master one indicator before adding another to your strategy. Keep testing, keep learning, and stay patient with your trading journey. If you found value in today's video, smash that like button and hit subscribe to stay updated with more trading insights. Don't forget to turn on that notification bell to catch every new video as soon as it drops. Drop a comment below with your favorite indicator combination. Let's learn from each other. See you in the next video, and until then, keep trading smart. Thank you.